Hey investor friends, I'm Michelle Markey, and today I'm going to share my key takeaways and the wisdom I gleaned from famous value investor Mohnish Pabrai and the talk that he gave to London Business School MBA students on May 19, 2021. And as many people know, Mohnish Pabrai is a disciple of the way that Warren Buffett, Charlie Munger, and Ben Graham invest. And over the last year, since 2020, he's been reading up on Nick Sleep's letters, and he's also shared how those letters have helped him to evolve his investing process. And in addition, Mohnish also touches on how there's been a sea change in the restaurant food delivery industry. And he also talks about his thoughts on GrafTech and a little bit on Alibaba, but not too much, as well as what's going on with Mumbai real estate. And if you also enjoy learning wisdom so you can apply it in your own investing practice, I'd love if you could please like and subscribe to my video and YouTube channel, because it greatly helps out with the YouTube algorithm and because I'm trying to help us be the best investors we can be. Thanks. First off, I think Mohnish Pabrai is an excellent storyteller because he talks about the time when he came to the US at the age of 18 in 1983 to Clemson, South Carolina. And back in those days, 38 years ago, you could only dine in at Pizza Hut. And then over time, there was a little bit of delivery. And for the longest time, pizza was the only thing you could have delivered to your house. And now in the last year and change, we've seen the sea change that Mohnish refers to as the rise of the food delivery services, and how there's also the increase of ghost kitchens, so much so that there will be more efficiencies over the next several years that we see as more and more restaurants join into this concept of ghost kitchens. And he refers to the cloud kitchens operation. And that's going to be a huge difference in the coming years than what maybe we've been used to when a lot of us might have dined in. But honestly, I can't remember the last time I dined in at a place like Pizza Hut. Like, I remember you could dine in and you could have some food from the salad bar too. And I was especially fond of getting a free personal pepperoni pan pizza because I was able to read some books in school. And as much as I didn't enjoy reading books, I was able to get that little slip of paper that entitled me to my own little pizza. And that made me happy. So as much as I have fond memories about Pizza Hut, I think I only ever got takeout from there and not so much dined in. So I think that Mohnish is onto something by saying that we're going to see more changes and efficiencies and opportunities as more ghost kitchens come online. Someone asked for advice when it comes to running a business, and Mohnish said that Warren Buffett said that being a business owner made him a better investor and vice versa. And as investors, we're accustomed to analyzing businesses with spreadsheets, but a lot of entrepreneurs don't run their businesses on a spreadsheet. They focus on the 3 to 4 variables that affect 80 to 90% of the outcomes. And he said there's something to be said about having to make payroll and also to have gotten customers so that the business grows and succeeds. And then he also talked about in our human development, when we're being born, our brains are the biggest organ, and it goes through rapid growth in the first 5 years. And then when we're 11 through 20, that's when the brain is optimized to specialize. And often in our Western education system, we become generalists in that we learn all different kinds of subjects. And maybe that's when we're not applying our brains in a very productive way, the way that Warren Buffett learned how to invest at the age of 11, or how Bill Gates was playing around with computers in his early teenage years. So there's something to be said about succeeding in life when we specialize early on. And he says that Germany gets it because they allocate their kids into certain career directions early in life, like the ones who are going to go to college or go into manufacturing or other vocational occupations. And because they're specialized, they have some of the best paying manufacturing jobs in the world, whereas commonly the economics wouldn't allude well to that. So he says that Germany does it right in the way that it gets young people to specialize early on, and maybe that's something that the rest of Western education should consider as far as helping kids to reach their full potential when they grow up. And then he talked about how he should have been talking to those London Business School students when they were 12 instead of now, because he would have had the most impact when they were much younger instead of now when it's just for entertainment and no impact. And that was a little bit funny, but I think that hopefully we can still all learn some wisdom from how he talks about this concept. And he also talked about if you set up something like running a lemonade stand when you were 10 years old, or in my case, buying and selling Pokemon cards, that makes a huge difference in your ability to run or manage a business 20 years later. And he said to always pursue your passions and to take a job that you would do even if you weren't getting paid. On the topic of inner scorecard and starting a fund, he cites Charlie Munger in that you should already be independently wealthy if you're looking to start a fund, and you should have proven to yourself with the power of compounding that you were able to manage and grow money, and that's the ultimate litmus test to see if you're ready to start a fund. And he said that his biggest mistake for the longest time was following the Graham concept of discounted pies as opposed to the Munger concept of growing pies. And he says that there's two main steps, and 3/4 of the battle is studying the frameworks, and then the second step is applying it. And he said that to think like Nick Sleep, as if we are the founding family member of the business and we're in it for the long haul, because the world doesn't always calibrate what it thinks of you appropriately. And so what this means is that we should look internally to measure how we've lived up to our values and our sense of integrity, and did we pursue quality and try to do a job well done. And if we can convince ourselves that we did that and that we were trying to do the best job possible, it's okay if the outer scorecard is like how Nick Sleep wanted to be known, as that he turned $1 into $10. But the most important thing is, how did he do it, and did he do it well? So he tried to measure himself internally if he pursued quality appropriately. When it comes to management, Mohnish said that until recently he didn't used to interact with CEOs because they're incredible sales guys and they wouldn't have gotten to the position they're in life without being great at sales. And he says that they're usually experts at the subject you're talking to them about, and they're high on charisma. So your understanding and perspective of the business could be distorted because of your warm and fuzzy feelings about how great of a leader the CEO is. And he talked about how we should look at what the CEO said 10 years ago and see what's transpired since then, and to focus on the track record and the history of what's gone on, because there can be gray areas when it comes to CEOs. Like he says that it took him 15 months to figure out how one CEO was really not that great. And so it's hard to discern from body language whether a CEO is great or useless. And he also cited how Warren Buffett said at a recent Berkshire Hathaway annual meeting that one of the biggest risk factors that 10K or 20F annual reports don't talk about is whether the CEO is thoroughly incompetent at his or her job. So that's something we should all keep in mind and really evaluate whether the CEO is really competent and knows what they're doing. And he also cited how Jeff Immelt, the CEO of GE in the past, how there was a little bit of controversy surrounding his performance at GE. And he said how Jeff checked all the boxes. Like he was very tall, he was handsome, he was either the president of his fraternity or was part of one, and how he was leading the football team. And he had all the boxes checked for what you might expect from a typical CEO of a major company. But yet there's some degree to which maybe Jeff wasn't the best CEO in retrospect. So that's just something to bear in mind when it comes to what we tend to think of CEOs and if they really are doing what's best for the company's future and able to generate earnings. Someone asked about GrafTech, and Mohnish was willing to talk about this one because he was no longer invested in that company. And he talked about how it was a pretty mathematical equation for the investment in this company, where he knows that 3/4 of the contracts of the take or pay contracts were already 3/4 sold for their graphite electrodes. So the business was pretty known, and you could easily project out the market price and level of production with GrafTech. But then when the events of 2020 unfolded, a lot of people could get out of these contracts using the force majeure clause. And just like how we used to have a non-refundable airline ticket, we suddenly could get refunded for them. He was afraid that there was going to be a lot of uncertainty with these contracts, and it was no longer certain how much GrafTech was going to be able to earn in the future. So he was happy to get out at a small profit. But since he sold out, it's actually gone up a little bit, but he says that he's moved on from that investment. And then someone asked about Alibaba, and with a coy smile, Mohnish said that he would like to duck that question, and then proceeded to say that maybe if they invite him back in a few years, and if he no longer owns Baba, then he would talk about it. but he said that he may own it for a while. So that's salient point number one. A few more salient points that he shared included how he said that at that point in time in May 2021, they were still adding to their position. And he says that even though he doesn't like talking about positions in his portfolio, the company was going through changes as they spoke. And he says that he must like it if he's buying it, and that's all he could say. But then he continued on saying that it's a business worth studying and it's a fascinating business. So I think those are some pretty incredible hints that Mohnish gave about what he thinks is the future of Alibaba. When it comes to asset allocation and portfolio sizing, Mohnish cites Charlie Munger in saying that for diverse stocks, carefully selected is all you need, with the operative word being carefully selected. And he says that if you have a McDonald's and a Ford dealership and an office building and apartment complex in somewhere like Peoria, Illinois, even if some people criticize that and say you're too geographically concentrated, having only those 4 diverse assets is more than enough, and you're more than likely to live a happy life as an investor, even if you don't own them fully and just partially own them. And he says that most entrepreneurs only have 98% of their assets in one bet, and they don't even have 4 bets. So he says that they're just single bet, all eggs in one basket, and they don't have sleepless nights. And he says that if you don't know what you're doing, please index. That's still an honorable way to go. But if you do understand what you're doing, he cites Warren Buffett in saying that if you have 27 business ideas, why would you invest in your 27th best idea when you could be investing in your 3rd best idea? And he says that when it comes to Pabrai funds, he likes to try to do a 10 and 10 model where he has 10 positions split across 10% each. And he says that in his personal investments, sometimes he only has 1 stock. So that's something to bear in mind about how he is super concentrated and he follows very closely what Charlie and Warren preach. And he also talks about how in his philanthropic ventures with the Dakshana fund, in that scenario, they swing for the fences, whereas you never want to swing for the fences when it comes to investing normally, because when it comes to spending in philanthropic ventures, you're trying to spend as much as possible and be willing to fail. But he says that even so, he has $22 to $23 million in the Dakshana fund, and that's all concentrated in about 3 to 4 positions, and he thinks that it will grow nicely. So he's very concentrated in both his regular fund business and his philanthropic ventures. There was a question about real estate in Mumbai, India, and Mohnish reacted in saying that 80% of it is a total teardown. But even though he didn't want to get too much into his own investments in real estate, he said how the economics of a 40-story tower building become very compelling. And he talked about how with some developers and tenants, they can negotiate so that even when there's a tear down, the interests of the condo owner are protected, and also the tenant gets some perks when they might move back into the newly developed building in the future. So that's one way that the laws are working in the favor of protecting the interests of apartment building owners. And then also when it comes to slum redevelopment, he said that it's a very dirty business and that there are third parties who are redeveloping it, and then they need to have a place for the people who used to live there to be able to live there, even if something like a Ritz-Carlton is going up. Because those inhabitants have their livelihoods there, they need to have housing in the same area. So that's one way that this is being redeveloped, and he said that it will happen in fits and starts, but because the land is so valuable in Mumbai, it will happen in the future. When asked how much time he spends on macro factors, Mohnish said he spends almost no time because he has no competence, he says, in macro factors like currencies and interest rates. And he uses an example of a Coca-Cola bottler in Turkey. And he says that Coca-Cola itself owns like 10 to 20% of it. And also 3G from Brazil also has a stake in this Turkey Coke bottler. And he says that they can still raise the price of Cokes even if the currency is being devalued, because people still want to enjoy this kind of drink. And he says that the economics of this bottler are just as good as the other bottlers in other parts of the world, but for some reason is still selling cheaper in this country. And he says that it still has really good management, a good family, and set of investors that are invested in this bottler. So it just goes to show that you can still find good businesses no matter what's happening at the macro level. Someone asked a great question about how his investing philosophy has changed and what he's learned from Nick's sleep, and if that's affected his due diligence and other parts of his investing process. And the first thing that Mohnish talks about in this regard is about how maybe the 10 commandments need to be whittled down to maybe 5 commandments. And he talks about how there's someone who went up to God and said, hey, look, I can't remember these 10 commandments. Just give me one. And then God said, no problem. I'm God. I can answer that. And he said, this one golden rule, which was do unto others as you would have them do unto you, and just follow that one commandment, this one edict. And that's what Mohnish is trying to come away from Nick Sleep's letters, is a similar main point to bear in mind as we go further in investing. So he goes on to say how Nick Sleep added a layer, and he says that even though it was already embedded in Buffett and Munger's teachings, he said that there was also something more to think about, in that think of yourself as a business owner. And he said how in 1995, when he sold a portion of his business for $1 million, he put $40,000 in the Indian stock market into 4 bets. And he says that one of them took off, like it returned 140 to 160 times. So that was at least 150 bagger. So his $10,000 in that one stock became $1.5 million. And that was in a short amount of time. In 2000, he sold his stocks. And then he also noticed that his 3 other bets were either flat or down. And then he thought it's ordained, like if you get one 100 bagger, then why bother holding on to the rest? So he regretted actually selling his stocks back then, because he didn't have to. If he had held on to one of them that ended up becoming 500 bagger, he would have needed to hold that for 26 years. And some of his positions that he sold back then that he regrets selling but wishes he would have held on to them included Kotak Mahindra, where that one returned tremendous amounts over the years, and it also gained its banking license, and it went off and it went asymptotic, he said. And another one was Blue Dart, which he says is the FedEx of India, and people needed to be assured that their packages would be delivered. So he said that he invested in 2 of them, both Blue Dart and also SkyPack, and SkyPack went down 90%, but Blue Dart took off, and even FedEx has a stake in that one now. So he also just talks about how he wishes that he would have read Nick Sleep in 1994 instead of in 2020, because he would have held on to these stocks through to today and not have sold them back then. Arguably, the most important thing that Mohnish learned from Nick Sleep is to first ask the question, what is the destination of the business, and where does it look like it will be in 10 to 20 or 30 years from now? And the second question is the business getting better? Is its moat getting wider and deeper? And the third question is the valuation reasonable? It can appear to be overvalued, and that's okay, but it just can't be egregious and not crazy overvalued. And he also says that in retrospect, he had no reason to sell. Both the valuation and destination of his 4 Indian stocks look good. And he says that what he learned from Nick Sleep is to make sure we're just buying great businesses run by great managements, and to not sweat the intrinsic value. Like if we think the intrinsic value of a business is $100 million, so we think it's worth $100 million, and it's selling for $125 million, we shouldn't worry about selling it. We should just hold on to that and to keep asking ourselves, what is the destination? If the entrepreneurs aren't selling, then why are we selling? So my takeaway is that this is his main commandment that he's taking away from Nick Sleep, is to ask what is the destination of the business. And if you bear this in mind, then you're less likely to sell a winning company. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.